Hey guys, this is going to be a trade idea on Priceline PCLN. The stock is expected to report earnings on August 10th, 2015. That is 15 trading days away. I'm bullish on the stock. I think it's setting up for a breakout to the upside. And I want to make a directional bet higher, but I want to do it with limited risk. So I'm going to talk about a trade idea here. But first, I want to talk about why I'm bullish. You want to know why I'm bullish? Boom, here's a chart of Google. Google went up 125 points last week, 100 points alone on earnings. That's why I'm bullish on Priceline, okay? I'm not going to dive into anything else. Not even going to, nitpick Priceline. I'm bullish on Priceline because of this Google chart. Simple enough, all right? So now for some light research. I went ahead and looked at the last 9 earnings reports on Priceline dating back to May 2013, and I calculated 2 moves. The first was, how does the stock perform 15 days ahead of its earnings report? In other words, does it see a run up or a run down ahead of earnings? Next, how does the stock react on the actual earnings day? Does it make a big move or not? What I found with Priceline is that the biggest move on Priceline doesn't happen on the earnings day. It happens on the move into earnings. And you can see here 15 days out, when the reaction has been positive, in other words, when it has rallied going into its earnings report, the stock has made a very nice move to the upside. On average, when it is positive in the 15 days leading up to an earnings report, it averages a gain of 8.44%, with the smallest being a 4.5% rally and the largest being a 14% rally. Priceline tends to run up into earnings over the last couple of years. It's only been negative in the 15 days ahead of earnings 2 times. May 2014 and November 2013. Both times in August, the report we're going into now, it had a run up into those earnings of roughly 5%. Then on the actual earnings day, kind of a mixed bag. You've got 6 positive reactions, 3 negative reactions. The negative reactions have been greater on average than the positive reactions. When she trades down the day of earnings, it averages a 6.7% loss. When it trades higher the day of earnings, it averages a 5.5% gain. What's interesting to me, though, and what I'm factoring into this trade idea I'm about to show you, is the combined move when both the run-up and the earnings day reaction is positive. You have a combined move of over 13%. If we just apply that average to Priceline here, and we assume that there is going to be a run-up, which isn't necessarily an intelligent assumption, but it's the assumption I'm going to make because I want to put on a directional trade since I'm bullish on the stock, and we take that 13% average from Friday's close of 12.16. If you say it does the average, we're talking about a 158 point move here post earnings, which would take Priceline stock to $1,375. If we assume the lowest move that it's done in a run-up, which was 4.8%, actually it's 4.5%, so it's a little less here, but it would take the stock to about 1,200. Okay, and then if we assume the smallest positive move in reaction to earnings, then it takes the stock to about 1318. That is on the smallest positive move over the last 9 quarters, if you just look at that. What's interesting, though, to me, you look at these August reports. You had one report, 2014, where it was a low positive gain, only 3.6%. But then you look August 2013, and it was nearly double that, 6.6% return. So kind of a mixed bag for August, not drawing any conclusions off of that. Bottom line, if Priceline does rally and has a positive earnings reaction, these numbers would seem to suggest that it's going to be going above $1,300. If it does the average rally ahead of earnings, and then the average move, it's going to be going above $1,350. I want to bet on closer to the average move happening. I think Priceline will make a good move to the upside, and if it doesn't, I'll lose my money, and that's all well and good. So what I'm looking at here on Priceline is the call strikes, specifically the 1330 strike call. So you look at this for August, it's going for $8.60. I don't want to spend $860 to get a directional bet going on Priceline. And you say, okay, we'll just go further out of the money. Well, look at the 1370 calls. These are still going for $5. I don't want to spend $500 in order to participate in the Priceline long side. That's too much exposure for me principal wise. Maybe it's not for you, but it is for me. Granted, if it does the move like Google and it goes nuts, these are going to pay out multiple bags. But hey, I'm not betting on that. I'm just betting on a good average move to the upside based on what I've seen over the last 8 quarters. So what I want to do is I want to do a call spread on Priceline, and call spreads are great because you can really gain exposure while limiting your cost tremendously. So I'm looking at buying a vertical call spread, and so the way you do that is you buy a nearer the money strike and you sell a further out of the money strike. So what I'm looking at specifically is the Priceline 1330 by 1350 August 14th call strike. Right now this is going for between $2 and $3. And my upside is 20 bucks. That's the difference between the strikes. 1350 minus 1330 is $20. So my maximum gain here is $20. Right now I could get this for about $2.20. Obviously it might be a little bit different tomorrow once the market opens. But I would much prefer this type of trade where I only have to pay 220 bucks to gain the exposure, and I still have 1000% upside if it does go above 1350 versus paying $500 for a 1370 strike call and needing the stock to not only make an average move but an above average move and go way far to the upside. So I'm putting in an order here. I want to buy this 1330 by 1350 August call strike. I want to buy it for $2. So I'm just going to place that. Oh, sorry. Guess I need to make it good till canceled since the market is closed here. But so that's my trade on Priceline. My risk here is only what I put in. So it'll be 200 bucks if it fills. And my reward is if Priceline goes above 1350, I'm at max profit. I will have a $20. I will be able to sell this for likely close to $20 if Priceline pushes above 1350 at this August 14th expiration. All right, and anything below 1330, I lose 100%. But anything above 1332, I'm at break even. How do you figure break even? Well, you just add what I'm going to pay for the strike, for the call spread, $2 to the lower half of the strike. So it would be $2 plus 1330, that's 1332. So I need Priceline to be above 1332 to break even. If it's at 1331, I'm down $1, down 50%. If it's below 1330 at expiration, I lose 100%. But that's much better than if I'm wrong about this and I bought a 1330 strike call for $8.63. Then I would be out 863 bucks. That would suck. This one, I'll be out 200 bucks. That's a much more comfortable risk for me. And if it does end up going above 1350, I will be able to participate, and profit with $1,800 worth of gains, which is more than enough for me. Might not be the thousands and thousands you could make if you just have the unlimited exposure by being straight long calls, but this is the trade I like for me. This is the one I'm going to look to put on. Buying the Priceline 1330 by 1350 call spread for $2. Good luck.